Results will now be recorded.
Good evening to everyone present for today's session. Is my voice audible to all of you? Can I just confirm?
It's little low, ma'am.
Is my voice audible? Yes. Am I audible?
Chat box ಅಲ್ಲಿ ಅವ್ರಿಗೆ ಪಿಂಗ್ ಮಾಡಿ.
Yeah, that's fine.
So ಏನಾದ್ರು ಚೆಕ್ ಮಾಡಿ.
Am I audible? Just confirm once.
So check the status. Is that audible? Start. They can speak.
You're able to hear my voice?
Yes, ma'am.
Yes, ma'am.
Okay. Just plug out the earphones. Fine. Now, yeah, to your this one, what is that? WhatsApp group, I've sent the Walmart case study. Please open the case study file. Open that case study, download that file. Okay, a Walmart case study will appear something like this. It is directly, put it up in the Excel sheet. Yes. Have you opened the case file?
Yes, ma'am.
Right. So here, let me discuss about the project with you, and post which we will solve all these. It is very similar to your Volvo case study. Very much similar to your Volvo case study, but Volvo had given you a case study in a Word file. Discussed that first, and then we have worked on the Excel workbook. So this is I have given directly in your Excel workbook itself. Okay. So the total project cost for this project is totally around how much? It is 100 lakhs. Okay. Now, out of this 100 lakhs, how much loan is being sanctioned? 55% loan, 55% of the total amount is being sanctioned as loan, and the remaining is raised by way of equity, which is 45%. Okay, so I'll repeat again. So the 100 lakhs is the loan requirement, okay, to invest in this project, out of which the bank sanctions only 55%. Remaining has to be raised by equity, which is 45%. So the rate of interest charged by the bank is 13%, okay, and the cost of equity is 25%. So the project cost is incurred in the zero period, that's the initial stage. Asset recognized worth the project cost with a useful life of 4 years. So the useful life of the complete project is 4 years, and there is 0% salvage value. And depreciation is as per the Companies Act, which is the company is following the straight line method of depreciation. That is, here the rate of depreciation is 25%. So, evaluate the business proposal using the net present value and the internal rate of return, which I've already worked on. So here, let me discuss the drivers. Okay. So, what drivers you have here for the initial period, that is year one. The selling price for one unit is 3,750 in the year one. That's the startup year, and the cost price per unit is 2,750. The total quantity is 25,000, which means for the entire year, what is the total volume sold? It is 25,000. Okay. So per unit, the selling price is 3,750, cost price is 2,750, quantity is 25,000. And every year, okay, growth I've given you see the corresponding column year by year. We have a growth of how much? We have a growth of 10%. Okay. So every year the sales increase by 10%, and the cost price also increases by 10%. So, and in the volume sold, okay, the quantity sold, we have an increase of 5%. And So here, let's clear this first hurdle and then we'll move on to the rest. Now after the assumptions sheet, we have the drivers there. So these drivers are to be put on the table in the Excel sheet what I've given. So please open sheet 2. Sheet 2 by the name drivers. So when you open sheet 2, you have to update the details there. Now only for the year 1, you have to just update it manually, post which you can just add up the increase in the volume, increase in the cost price, increase in the sales price. So equals to. So for year 1, what is the selling price per unit? It is 3,750. So you can just put up. Okay, and the cost price is 2,750. And the total volume is 25,000. And from year 2 onwards, we have an increase of 10%. So equals to year 1, 1 plus. First observe and then you can do it practically. 1 plus 10% and close the brackets. So again, this cost price also increases by 10%. So 2,750 into 1 plus 10%. And then the volume 1 plus 5%. Okay. So for year 3, year 4, you're just going to extend the increased values. So please do this. Please work for complete these drivers. Yes, are you done, Farah? Able to get the drivers?
Yes, ma'am.
I hope all of you have completed these drivers. No doubts are there. So next one we go is for the generation of the income statement. Okay. Okay. Now, how do you generate the revenue from year 1 to year 4? Year 0, we know it is the initial period. From year 1 to year 4, how do we generate the revenue is what you're going to watch. Okay. So, revenue is what? Equals to, okay, just please carefully observe how I'm doing this with the usage of the drivers. Now, equals to, I'm going to the drivers, selling price into volume and press enter. I'll repeat again. Please observe. Give equals to here. Go to the driver sheet, which you did just now. How do you put up the revenue? Total sales. Selling price per unit into total units sold. So, selling price into volume. So, you get the revenue for the first year. And cost also in the same fashion. Equals to, go to the drivers, cost price per unit into total volume sold. Okay. And from the second year onwards, the same thing. You do it for the first year and you take care of the rest of the years. Again, the cost also compute for the first year, take care for the rest of the years. So compute your revenue and the cost.
Ma'am, can you please do the revenue and cost again, the first year one?
For first year, you want me to repeat both? See, I'll repeat again. Please look at the screen. See by here, I'll come to the year 1 revenue. Now, usually how the revenue is generated, the total sales is generated, selling price per unit into number of units sold, correct? So what I'll do is for year 1 equals to, where is my selling price per unit and my volume sold? It is in my drivers only. I need not go to the assumptions. All the details are being put up in the drivers. So I'll go to the drivers. I'll take selling price per unit, and I again don't shift back to the income statement sheet immediately. I'll stay there in the driver sheet into volume. And now when I press enter, I'll immediately go back to the income statement sheet. I'll repeat the same for cost. Again, you can observe equals to, how do you generate the cost of the goods sold? Cost price per unit into total volume sold, which you're aware of it. You've been doing income statement for a very long time. So how do you derive the cost of the goods sold? Cost price per unit into number of units sold. So here I'll put up equals to sign. Go to the drivers, cost price per unit, shift and then into sign or multiplication sign, and then units sold. Now I press enter. So I get both the values. Once I get for year 1, I'm going to drag it for the rest of the years. I hope it's clear now.
Yes, ma'am.
Please complete these two, revenue and the cost. you complete the computation of revenue and the cost, okay, please calculate the gross profit. So what's your gross profit? You've already done revenue minus cost of the goods sold. So equals to revenue minus cost of the goods sold. Clear? Revenue minus cost of the goods sold, and then for the rest of the years again complete it. Are you done with the gross profit computation? Are you able to get it?
Ma'am.
So now we head on to the operating cost, operating expenses. So I'll go back to the assumptions. My first sheet, I'll go to the assumptions, my first sheet. And here, can you see how the operating expenses are arrived? Can you see OPEX here? After your drivers, you have got that OPEX, okay, in A20. OPEX means operating expenses. So operating expenses account for 20% of the revenues. Okay. So how do we compute the operating expenses? It accounts for 20% of the total revenue generated for that particular year. So 20% is the rate. So I'll go back to the Excel sheet. Sorry, I'll go back to your income statement here. Equals to revenue into 20%. Okay. And for the rest of the years, compute. And once you compute the operating cost, calculate your earnings before interest and tax, earnings before interest, tax and depreciation. What is that? EBITDA equals to gross profit minus your operating cost. You should be able to get this around 62,50,000 as your EBITDA. Are you able to get the EBITDA, earnings before interest, tax, and depreciation?
Yes, ma'am.
Now the next step we go is to compute the depreciation amount. So I'm going back to the assumption sheet, and yeah, if you scroll, what is the total project cost? It is 100 lakhs, okay? And yeah, come to this line, asset recognized worth project cost with a useful life of 4 years and 0% salary to value. And the depreciation as per the Company Act is 25%. And a straight line method is being followed. Straight line method means you have the uniform amount of depreciation for all the years. So you have to compute 25% of your 100 lakhs. Okay, so you can just go back to your income statement equals to, okay. So here, see if you do it like this into 25% here, you can work like this. I'll repeat again, equals to, go to your assumption sheet, 100 lakhs into 25% of your depreciation and press enter. It will give the depreciation for year 1. Okay. The thing is here you cannot do any kind of freezing. See, it will come like this. That's why I was teaching you the usual way. Okay, so you can just do the same thing, or you can just manually put up and then drag it for the rest. That can be done. Okay, because it's a uniform amount of depreciation, we consider it like this. And for here, and once you compute the depreciation, calculate your EBIT. What is your EBIT? Earnings before interest, tax, and depreciation minus depreciation. You should get EBIT. So equals to EBIT DA minus the depreciation. Okay, that's all. Yes. Are you able to work your EBIT?
Yes, ma'am.
I'm getting only one response. What about the others here? Yes. What about the rest? Only one is answering. What about others' response as well, apart from Akhil? Okay. One has answered. Fine. So after computing your EBIT, next we're going to step up to the other case, other step. So here, coming back. Now, how do you calculate your interest expenses? Okay, so I'll go back to your assumptions first. The total project cost required is 100 lakhs. Out of this 100 lakhs, how much of loan is being sanctioned? 55%, and for that the interest rate charged is 13%. Now the complete debt schedule is already readily been given for you here. You will not even calculate and break your head. It is already given for you. So here, now you have to add what? You have to add the interest expenses incurred for every year for this project. So this interest expense is put up here only, the last row here. Please look at the debt schedule here. So in this debt schedule, the interest expense is put up in the last row. So these values you have to add up in your, see, for year 1, 7,15,000, for year 2, 6,50,000, for year 3, 5,20,000, and for year 4 it is 3,25,000. So these values you have to add up in your income statement. So equals to, just add up. One you add, and for the rest you can take care. And no interest income, so you directly come to the EBT, earnings before tax. So equals to EBIT minus interest expenses. Yes. So if you're able to get the EBT, please compute the tax now. So what is the tax, ma'am? I'll go to the assumption sheet here. What is the tax rate being given for this project? Yeah. See here. After the OPEX, we have is the tax rate. So tax rate is 30% on the PBT or the EBT. So 30% is computed as a tax on the applicable EBT or the PBT. So what you can do is equals to your EBT into 30%. That's all. And then calculate the tax for the rest of the years and finally arrive at your PAT, profit after tax, or the net income, equals to EBT minus tax. Completed the income statement. Kindly do the calculation and cross check your values.
Ma'am, we haven't done interest income here.
What now?
We haven't done interest income here, ma'am.
Interest income, no. Only the interest expense is supposed to compute.
Okay, ma'am.
Okay. Yes, I will done with the PET calculation.
Yes, ma'am.
Yes. So once you have completed the PET calculation, you have done with the income statement, and now you have to switch to the next sheet, which is balance sheet. I hope all of you have completed here. So please go to the balance sheet next. Now, I'm starting off with the balance sheet. And here, we start with the working capital computation in the balance sheet, and then we'll discuss the rest. Now, coming to the working capital, okay, it says that the working capital requirement for every year is 4% of the revenue generated by the company for each year. So, working capital requirement for every year, from year 1 to year 4, year 0 is the initial year. So, from year 1 onwards, the working capital is 4% of the revenue generated. 4% of your revenue, that is this. Okay, that is your working capital requirement. So it has been given up here 4% of the total revenue. So because year 0 is the initial year, we start off with the year 1. So year 0 there is no working capital because it's the stage. Okay, so we can just give it as equals to 0 and then start from year 1 equals to your revenue into, okay, it is 4%. So you should be able to get the working capital 37,50,000 and you get it for the rest of the years. Please calculate the working capital. I hope all of you have got the working capital. Then PP gross, property, plant and equipment, the gross value of your fixed asset. So what is the total value of your asset? It equals to 100 lakhs. Okay. So just from year 0 to year 5, 4, you have the same value which is being. Okay. 100 lakhs, the gross value. So initial year we bring up the asset for the project, and the total value is 100 lakhs. So after entering the PP gross value, we put up the values for the depreciation. There's an accumulated depreciation. Please observe carefully and then you work on that. Okay? For the initial year, what matters? It is 0. Okay? Followed by for the year 1, how do you put up? Year 1 plus year 0. Remember, we had done this in the previous case. Accumulated depreciation equals to the current years plus the previous year. So current years, where do we get? In income statement, we have the current year depreciation plus previous years. So come back to the balance sheet. Okay. Clear. So previous year plus the current year. If you want, I'll repeat it again. Shall I? Or is it clear for you?
Yes, ma'am.
Is it clear?
Can you repeat it again, ma'am?
I'll repeat it for you once again. Yeah, but see, for year 0, your accumulated depreciation is 0, so equals to 0. For year 1 onwards, how do you compute the accumulated depreciation? What is accumulated? Current year depreciation plus the previous year's depreciation. So for year 1 equals to current year depreciation. Current year where I'm having? I'm having an income statement. So you can do either of the ways. First, it is safer to select the current year depreciation. So equals to, go to your income statement, select your current year. Year 1 depreciation is here, 25 lakh. Okay. Plus, come back to your balance sheet and add your year 0 depreciation. So it comes up to 25 lakh. IS means income statement, BS is EPUB, balance sheet. So plus your balance sheet value, add the cell, give the cell referencing here, and once you press enter, you get the value. And for the rest, you can just drag it to calculate the accumulated depreciation for the rest of the period. I hope the accumulated depreciation is clear for you.
Yes, ma'am.
So once you finish the accumulated depreciation, calculate the net value of your property, plant and equipment equals to gross value minus depreciation. That's all. And then compute your total assets. So please observe carefully here how you compute your total assets equals to your cash plus working capital plus net value of the property. Nothing but net value of your fixed asset. I'll repeat again. Equals to cash first asset plus working capital plus net value of your asset. So after you compute your total assets, now you add up the liabilities part. So coming to the debt. Debt is, you have seen, 55% is sanctioned as debt, remaining 45% is equity. So debt equals to, go to the assumption sheet, Yes, your end of the period debt is there. You can observe this, right? 55 lakh, sorry, yeah. For year 0 it is initial amount of loan 55 lakh, then 50, then 40, 25, and year 4 it is 0. So this end of the period debt is what you have to put up here in the what? In the balance sheet. Is that clear? So equals to this value. Okay. I hope all of you are able to calculate the debt from year 0 to year 4.
Yes, ma'am.
Next is your equity. Now, equity accounts for 45% of your total requirement, right? So, this you can do it directly. 100 lakhs into 45%. Okay. So the same amount remains for rest of the years. The proportion remains the same. So, what you can do is equals to into 45. That's it. And for the rest of the years, the amount remains the same. And next, your retained earnings. It is a summing up of all your gains. So for the year 0, it is nil, equals to 0. And for year 1 onwards, please observe, and then time is given as usual. To make it all together, you can finish off your liability side. Retained earnings for year 0, it is nil, equals to 0. For year 1 onwards, equals to, okay. Please go to the income statement. Take your PAT for year 1, your profit after tax or net income, plus come back to the balance sheet, the previous years. And repeat again. Retained earnings for year 0, it is nil, equals to 0. But for year 1, equals to year 1's PAT. So go to the income statement, the previous sheet. Take your PAT for year 1 plus year 2, come back to the balance sheet. Okay, take year 0 here. The same thing goes for the rest. And once you calculate your retained earnings, please sum up and compute your total liabilities. Equals to sum debt equity plus retained earnings. And do it for the rest of the. So here you complete your balance sheet. Yes, are you able to get the total liabilities in the balance sheet? If you have any issue, if you have any doubt, you can let me know.
No doubt, ma'am.
Put up in the chat box, confirm, say anything. I know. So once we complete the balance sheet, next we move on to the cash flow statement. Okay? So the cash flow statement, please come to the cash flow statement. So here we start with the CFS now. First observe and then you can do it. Now for year 0, we don't have any PAT, so it will be equals to 0. You should know that. From year 1 onwards, enter your PAT, which you already got in your income statement. Equals to, go to your income statement, PAT for year 1. That's all. And for the rest of the years, just drag it. Okay, first observe and then Take your time and finish it up. Again, for year 0, we don't have the depreciation, right? So it will be nil. We don't calculate depreciation initially. Here equals to, again go back to your income statement, take your depreciation values. Which remains the same for the rest of the years. Next, your working capital changes. Equals to, please go to your balance sheet for working capital. That's for the first year, and not only this, okay, minus your previous years. So equals to year 2. This minus, come back to your cash flows. Again, take your previous years. Is that clear? I'll repeat again. Please look at your working capital changes. Your current year is subtracted with the previous year's balance. See. Year 0, take up as 0. For year 1, either you can take the exact value of year 1 because year 0 it is a nil. Otherwise, you can, from here on you can start doing your working capital changes. And how do you do that? Year 1 equals to, go to your balance sheet. Go to your balance sheet. Take the current year working capital requirement minus previous year. Okay. Same thing for the rest. Equals to current year minus previous years. Equals to current year minus previous years. This is how we enter the working capital changes. Equals to current year minus previous years. And once you update your working capital, calculate the net cash flow equals to sum. All the three. And close the brackets. So here, now when you sum up what happens, you're getting this value. So here, one second, wait. Just sum up this, once again. Just sum up these two and minus with your this. So now you're doing it. Once again, let me hold on, equals to this, I'm repeating it again, this minus your working capital. Yeah, just overload it. So minus working capital. Now you take the rest. This is the values. Finally finish your working. And here you can stop. You can just save till here. And tomorrow's class we'll finish up the investing and the financing activities. And one more thing I just want to ask. See if you're now we are ending the classes in another 3 days. Okay, and the last day you'll have your exam. Okay, FM exams, which will be online, where the link will be shared to you to take up the exams through the WhatsApp group. Okay, so now tomorrow is Friday and Saturday you have your exams. Okay, so let me, yeah. Saturday, if you're able to take up in the class, Saturday if you can able to take up the classes in the morning, would that be okay for you? So that we can wind up your regular classes and Monday you can take up your exam moment the link is shared to you. So if you're okay with the morning sessions, we can take up the classes in the morning on Saturday. You just think and confirm me in the group. Okay?
Okay, ma'am.
Is that clear?
Clear, ma'am.
Yeah, because Saturday, in case if you're free in the morning, we can wind up the regular classes, and on Monday you can take up your exams. The moment the link is being shared to you in the WhatsApp, you can open that link and you can take up your exams on Monday. Because again, one more class will be left on Monday, and again we have an exam on Tuesday. So my only concern is, since the classes are coming, continuously, let me not break the classes for another day. So Saturday, if you can take the classes, preferably in the morning, then we are done with the classes. And Monday, you can take up your exams, and then we can wind up the session. So take a decision and confirm me in the WhatsApp so that I can arrange the classes on Saturday. Okay?
Yes, ma'am.
Yes, ma'am.
Okay. So finish off till your cash flow from the operation. So tomorrow we'll continue with the investing activities and the financing activities to arrive at the closing value of your cash, and then we'll compute the returns, your IRR. Okay? Right. So I'll just close the session now. Okay, and see you on the tomorrow's class. Thank you.